Whether you're dreaming of a retirement with sand between your toes and a cold one in your hand, hitting the road to chase the winds of adventure, or spending time with your grandchildren, this show is intended to help you get there. Welcome to Coasting in Retirement with your host, Josh Knoll. You've worked too hard throughout your career to spend your retirement worrying. So sit back, kick up your feet, because we've got lots of financial tips and tricks to share to help you get exactly where you want to be. Here's Josh.
Good afternoon, everyone. Welcome in. Welcome to Coasting in Retirement. That's right. Thanks for joining us today. We're excited to have you. Josh Knoll here. Now, Michelle is off this week, so we are very happy to welcome back one of our regular co-hosts, Mr. Jay Stubbs, the director of the Gulf Coast for Providence Partners, who also serves as a sponsor for this show. Jay, how you doing?
Josh, I'm doing great. It's good to be with you in studio. And, while we miss Michelle, hopefully it's good to have me in here on some of the topics that we like to talk about with your clients and with the prospects that are listening.
Absolutely. Well, you mentioned studio. We are back again here in Coastal College's recording studio, beautiful downtown Fairhope. Do you have any trouble finding parking? I did a little.
You have to wait until class gets out.
Right.
You have to wait until class gets out, and then you can get a spot. And then today it's a little sunny, so try to find something under the shade.
That's right. Well, we're ready to put out another great show for those of you tuning in. Now, listeners, Jay and I are here today to discuss financial topics relevant to those of you in or near retirement, living your best life along our part of the Gulf Coast. Here's what we got in store for you today. First segment, we're going to deep dive on our topic of the day. Second segment, it's about 25 minutes past the hour. We'll have our news headlines of the week. Stay tuned for that, because there's going to be some pretty good relevant headlines we've got coming up. And then roughly 45 minutes past the hour, stick around for our third segment. We call it Josh's Crystal Ball and Big Mouth. And it's basically an opportunity to poke fun of me, because I do have a big mouth and I'm opinionated. But we're also going to see if Jay's crystal ball or big mouth had anything to say about recent financial developments. So buckle up, listeners. We got a lot to get to. Quick background on me for those of you new to the show. Again, my name is Josh Knoll. I am a fee-based financial advisor. I hold my FINRA Series 65 securities license, and I'm the owner of Gulf Coast Financial Advisors. We are an independent investment management and financial planning firm. We have offices in Fairhope, Orange Beach, and Mobile. You can find more information on me and Gulf Coast Financial Advisors by visiting our website, gulfcoastfa.com. Or feel free to give us a call, 251-327-2124. Now, if you just missed that contact info, do not worry. We repeat it several times throughout the show. All right, so and back to the show. Now, Jay, for listeners that are not familiar with you, please describe, if you don't mind, describe your role at Providence Partners, and then particularly for this episode, your experience.
Sure, Josh. So Providence Partners is one half of a company. The other side is Providence Benefits. That handles group employee benefits all the way down to 5 employees. So if you're listening and you've got an employer and you want to have them review your benefits or maybe enhance it, all you got to do is put us in touch. But on the Providence Partners side, that's where we deal with individual risk planning, and we assist advisors like you, Josh. So those listening, Josh is really good at what he does when it comes to retirement planning and wealth advising and helping you with your assets and making decisions with respect to that. But that's what he deals in each and every day. When it comes to topics of risk management, life insurance, disability income protection, long-term care, it behooves Josh and other advisors around the Gulf Coast to bring us in at Providence Partners, where we are the specialist in those areas of planning. So, Josh, that's what we do. I work with advisors and agents all over the Southeast, all over the Gulf Coast. Just so happens you're here in Fairhope, so it's nice to come over and help you with your clients as we work with them on their planning.
Well, and also, Jay, you serve as the strategic consultant for risk management for Gulf Coast Financial Advisors, and that role is very much appreciated. Gulf Coast Financial Advisors and Providence Partners are not affiliated in any form or fashion, but your company, Providence Partners and Providence Benefits, does sponsor this radio show, and we're very thankful for that.
Absolutely, and I'm happy to lend my 25 years of expertise to you and to your clients as you move forward. A lot of just had a meeting this morning, downtown Fairhope, 9 o'clock. estate planning case, a gentleman and his wife with another referring agent. We had a sit-down, informal conversation about, hey, I need to get coverage and create some estate liquidity because in that area of planning, my tax advisors have told me I need it. So we're not going to talk about the estate planning today. We'll save that maybe for a later topic. We've certainly done it in the past, but just, all things insurance related, Josh, with my CLU, chartered life underwriter, that does kind of make me an expert or a specialist in that area of planning all things life, disability, and long-term care. Happy to help.
Very good. Now, regular listeners, so Jay just mentioned 25 plus years in experience. Regular listeners will know I started my financial services career back in 2009, and I started on the insurance side of the business. So I don't have Jay's 25 years experience, but I got 15 years experience. Actually, 15 years this month, Jay. I got my life license.
Congratulations.
September 2009, of all things. So with all that, the table is set, Jay. I thought what we would do today, my 15 years, your 25 years, we're going to test each other's insurance knowledge, and hopefully in doing so, we'll shed some light on common questions around insurance, maybe address common misconceptions about insurance. Specifically, I keep saying insurance, specifically life insurance, disability income, and long-term care insurance. Those are the three things we're going to tackle today.
So for those listening in the car, driving down, if you have somebody with you and you want to place a bet on who's going to get the most insurance-related true, false questions right or wrong, go ahead. If you're feeling lucky, place a bet. Is it going to be Jay or is it going to be Josh?
My odds are 3-1. Jay's got better odds.
No,
So.
you've got a good background.
I've got a decent background. All right, so let's just do that. Let's start. So, and what I'm going to do, Jay, I'm going to start with some easy ones, get us warmed up, and then we've got several sitting here in front of us. We did our best not to dive too deep because we wanted to have honest answers quickly. So but we're going to warm up. So first, Jay, first one, true or false? Term life insurance provides coverage for a specific period after which the policy expires. True or false?
Well, the first part of that, Josh, is true. Term life insurance does provide coverage for a specific period of time. Your listeners will be aware of 10-year term, 15, all the way up to 40-year term.
Wow.
However, at the end of the term, the policy doesn't necessarily expire or go away. What happens is that term policy turns into annual renewable term where the premium starts to creep up based upon your age. So if I bought a 20-year term policy and I'm maybe in year 18, I'd want to look at that statement or that policy and make sure what's going to happen to my premium in year 21. And a lot of people are certainly aware of that. They should be made aware of it, but some people forget and they don't realize it. So when you think you're going to have a term life insurance policy for the rest of your life, obviously that's not the case. You buy it for the term premium, and that premium is the same each and every year for the term period you purchase. However, in the years subsequent to the term you purchase, that premium goes up based upon your face amount that you're carrying and your attained age. And Josh, we have a lot of situations come up where the client has called us and said, "What in the world just happened?
Right.
XYZ insurance company."
I went
they all
from 50
do
a month to 500.
Yeah, what, they just drafted it out of my account. What am I going? Don't worry, don't fret. We can get that money back for you. What you're going to end up having to do is sit down with your advisor, sit down with Josh and his specialist, and work up a plan if you still have a need for the coverage. But the answer is true. It does provide coverage for a specific period of time, after which it expires. That is false. It actually turns into ART.
Very good. All right. And I've got one personally coming up, Jay. I bought $2 million worth of term from Banner Life back when I was 30 or 31. So if you age me out, listeners, I'm pushing 50. So you and I are going to be having that conversation pretty soon about that. All right, you're up next. What are you going to hit me with?
Jay, this is Jay listening to Josh. Okay, Josh, here we go. Whole life insurance builds cash value over time. True or false?
Well, you hope so. I mean, that's why you buy it, right?
That's right.
Yeah. So the short answer is true, but there's context to this. Jay, I wanted to talk to you about that, Jay. I'm glad you picked that question. So whole life insurance is a permanent type of life insurance as opposed to what you just discussed around term, which, again, you can continue and carry term after the level term period, but it's going to, generally speaking, going to be prohibitively expensive for something that can go away just like car insurance as soon as you don't pay the premium. Whole life is intended, now, generally speaking, whole life in the beginning is going to be a little more expensive, but that premium tends to stay level over the life of the policy. In fact, a lot of times in the industries that are the things that we do, Jay, a lot of times we'll do a certain pay policy, 5 pay, 10 pay.
Pay to 65.
Right. Okay. And so my question...
That's age 65.
Yes. So I'm going to say, true to this, but I do have a question back for you to throw back on you because you got more experience with this. What's the difference? There's whole life policies, but the carriers differ that offer them. So what's the primary difference? Like I know there's mutual companies that offer whole life. There's publicly traded companies that offer whole life. What's the primary differences in those policies?
So we'll give you kudos. You got 100% on that question. It is true. It does build cash value over time.
All right.
There are different types of whole life. Some ride a dividend participation rate that is disclosed. That's one of the primary things that you want to ask about is what is the company, the insurance company, crediting my leftover cash value or cash after the cost of the insurance is taken out? What are they crediting me with? Fortunately, we're in a high interest rate environment, the highest we've seen in many years. However, we'll have some news here later on, so stay tuned for news in the headlines because we just had a little change in that area.
Yeah, we did.
But whole life has dividend participation rates, and those companies differ on the rates that they pay. You can simply call Josh or me or anybody. You can even look it up and see who are the top carriers that offer the highest dividend participation rates. However, I will say just because they offer the top doesn't mean they're necessarily the best.
Understood.
So you always want to take that with a grain of salt and look at the expenses within the whole life contract. But at the end of the day, a whole life contract or policy is a disciplined way for the owner of that contract to not only get the death benefit coverage, but also have some equity that they have built in it. What I like to also clarify is somebody might call you, Josh, and say, I want whole life. Do you necessarily want a policy that grows cash value, or do you want a death benefit that's going to last longer than a term insurance plan?
I like it.
And they often get confused and they will say, oh, no, that's what I want. I want a death benefit that's going to go out longer than 20 or 30 years. I want something that's going to be there the rest of my life. But I don't necessarily need the cash value component because I'm maybe investing with you, Josh, and have non-qualified investments and other assets that are working for me. So in that regard, sometimes the general consumer will confuse whole life insurance with a permanent type of coverage, which we deem as universal life or guaranteed universal life. So that doesn't have any cash value. But if you have a client, especially those that are aged 20 to 40, cash value life insurance and whole life is extremely attractive right now.
Okay, very good. Well, so you just teed me up for the next one I'm going to ask you. Now, the question I wrote out here is, it says, true or false? Universal life insurance offers flexible premiums and death benefits, but I want to add one little caveat to that, Jay. The insurance du jour of the day is index universal life on the life insurance side, right?
That's right.
IUL. So I'm going to ask you then, universal life, which is UL has been around for decades, IUL, which has been around for a long time too, but not as long as just a basic universal life. Do both of those offer, true or false? Both offer flexible premiums and death benefits.
Yes, universal is also synonymous with the term flexible. So what you can think about is, and a lot of companies name their universal life contracts flexible IUL or flexible whatever. So yes, it is synonymous with that. So where whole life, we kind of lock in the premium. It's going to be that each and every month, quarter, or year, and it's going to be that for the stated period of time, whether we do life pay or pay to age 65 or 10 pay. Universal life, inclusive of IUL, if we design a plan that's got a premium that's monthly or quarterly or annually or what have you, that premium can change. And that is contingent upon the needs of your client or the person that owns that contract. They can say, well, look, I don't want to put X amount of dollars in. I just want to put half that in. We can design a plan after you've had it for several years to put in lesser premium. We can design a plan to put in extra premium because it's growing tax-free under current insurance and tax code law since 1913. And that's a lot of people don't realize that as we have a policy that grows tax-free in its cash value. Not only does it have that, it has the income tax-free death benefit. But true or false question, back to you.
You're 2 for 2. All right,
so it is. Universal Life does offer flexible premiums and death benefits.
Yeah,
now,
my little cheat sheet here says you're right.
We can't increase the death benefit, but we can always reduce it.
Understood.
Now, if we wanted to increase it, that means we got to go back through underwriting with that carrier. We can't just bump it from $1 million to $1.5 million. But we can take it from $1 million down to $500,000 because our needs aren't as great anymore. And what we've done there is reduce the expense of the premium when we do that.
All right, very good. All right, so you're up, or I'm up. What do you got for me?
Yeah, you're up, Josh. I'm going to say this, and this is something we do a lot.
Okay.
Josh, your clients can change the beneficiary of a life insurance policy at any time. You can change the beneficiary of a life insurance policy at any time.
So
True or false?
this is true or false. All right. Now, this is tricky because it says you can change the beneficiary of a life insurance policy at any time. But as far as I know, Jay, that's categorically false, only true in the instance of the owner.
Ding, 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 ding. There you go.
Only the owner can change the beneficiary of the policy, not the insured.
That's right.
And definitely not the beneficiary can't change the beneficiary. It has to be the owner.
That's correct.
So that part would be true. So I'm going to say false to this broad-based statement. It's not specific enough. Am I right?
Yeah, you'll go with that. So we'll give you 100% credit on that as well.
Okay.
You
All right.
can, the owner of any life insurance policy can change the beneficiary.
Okay.
And that is an owner-driven contract. The same thing holds true for those of you out there in the marketplace that own an annuity. Only the owner can make any changes of life policies, disability contracts, long-term care contracts, and annuity contracts. Now, what we often offer is, through your firm, we always tell people, hey, it's time to do a beneficiary policy review. Not only do you want to look at that for your policies, but you want to look at it for your qualified plan assets because those, life happens. Life changes. Those changes can sometimes mean that you want to change your beneficiary from maybe a former spouse, or you want to change it from your kids to maybe an estate, or maybe you have gotten into a situation where you want to put a trust as the owner of the policy and beneficiary would be that trust. So always do a policy review, a beneficiary review, not only of your insurance policies, but your qualified plan assets, because you dictate how those are going to be distributed upon death.
Very good. Okay. All right. My turn, right?
Go ahead.
Coming at you. So, Jay, I'm going to go ahead and pivot. We said in the beginning of this segment we were going to talk about life insurance, disability income, and long-term care. So I'm going to pivot to disability income, okay? Now, listeners, when we're talking disability income, there's going to be a component, and maybe Jay hits me with this, where a lot of people recognize disability through Social Security benefits through the government. We're going to be talking about actual private insurance policies, whether it's group or individual, okay? So when I ask this question, this true or false of Jay, he's going to be referring to the private individual market for disability income. Good? All right. So here's my question, Jay. True or false? Most disability insurance policies cover pre-existing conditions. True or false?
So the answer to that is false.
Oh, okay. All right.
You thought you had me.
Yeah, I did.
Disability income insurance policies, if we have pre-existing conditions, maybe we have a back issue or mental or nervous issue, what disability insurance companies do is they will cover you,
Right.
but they will exclude, also known as rider, that particular health issue.
Well, like in my case where my knee fell off my leg about 4 years ago.
Yeah, all
Literally.
that basketball and whatever you
Right.
do in the water. Yeah, okay.
Yeah, when your kneecap ends up in the middle of your thigh, it's not a good thing. But on my disability income insurance policy, I'm not covered for my knee.
So
Why would you?
Yeah, well, so thankfully your job doesn't require other than you
Yes.
getting in and out of the car and going in and out of the offices and such like that. But a lot of people will want to make sure that, especially when they're doing a review of their disability income protection, that's protecting the pay of their monthly income. Should they have an event where they cannot continue to work for a long period of time. But if they maybe had something that was ridered or excluded 10 years ago and they no longer have that, you want to do a review of that policy because you could get that exclusion removed.
Right.
Or maybe not even be in a situation where you want to continue with that policy, but you want to do a replacement that has no exclusions or no riders. And a lot of things are physical, so knee, back, neck, arm, surgeons and medical professionals need to consider this, making sure that their policies are reviewed and those exclusions and riders are taken care of. But also mental and nervous, those things tend to pop up, and sometimes the insurance company will cover them and say, we're going to do that for a little bit higher premium outlay. Or they're just going to exclude it outright, and sometimes they let things pass. So, for instance, when I first got one of my disability policies, I just had a little, atypical skin cancer type of thing.
Right.
They ridered me for 2 years, saying in the next 2 years, Jay, if you have any cancer-related issues that cause disability, they're not going to pay that. But after 2 years, that rider fell off.
Very good.
So just a good, to answer your question, the situation is do a good review of your disability plans in place, but don't be shocked if a company puts an exclusion on there because of a physical issue you've had for many years.
Very good. All right, so Jay, we got time for 2 more. One from you, one from me. So you're up next, I believe. Hitting me up.
Yeah, we'll stay in the disability area because a lot of this comes up.
All right.
Josh, true or false? Disability income insurance premiums are tax deductible.
Oh, crap. Okay. All right. Now, here's what I know, Jay. I hope this is right. No, I know this is right. When it comes to disability income insurance, you can pre-tax deduct the premiums. However, you're going to make the benefit a taxable benefit on the back end if you end up drawing the benefit out. So the true or false, disability income insurance premiums are generally tax deductible. That is categorically true. However, there is a downside for doing said. Am I right?
You are right.
All right.
And
Ding, ding, ding.
So if you're listening to this and you have group long-term disability through your employer is deducting that premium unless they've designed it differently. Mm-hmm. 9 times out of 10, that premium is being tax deducted as an employer expense. That means your group long-term disability benefit would be taxable.
Right.
So when you do that math and you look at that benefit, just remember that's going to run through what your income tax rate is for that calendar year. The standalone disability policies, oftentimes what we do, we layer that on top of your group disability. Maybe we do it for sole proprietors and business owners. Do not deduct those premiums because we want that benefit to be a tax-free benefit when it comes into us.
Well, especially, Jay, like just broad example here, on a individual disability income policy for a healthcare, like a doctor, right? You're talking a recent case we did, get a nice policy. I believe the annual premium was somewhere around $9,000, right?
That's right.
So the tax deduction on $9,000 is going to be, a couple $1,000, not a nominal amount, but not a huge amount, right? However, the benefit on that policy, if it ever paid out in full, is hundreds of thousands of dollars.
And we don't want that to be taxed.
And we don't want that to be taxed at the 30, 40% rate, right?
That's right.
Okay, very good. All right, last one, Jane. I'm going to lump this together because I wanted to get to long-term care before we close this segment. So I'm lumping the two together because these are common misconceptions. So forgive me, but you're getting a double whammy here. And I'm going to give you the opportunity to win it because we're tied right now. True or false? Medicaid covers everyone who needs long-term care. And follow-up question, true or false? Medicare covers the cost of long-term care. All right, Medicaid, true or false? Let's cover long-term care, everyone.
So Medicaid covers everyone who needs long-term care. That is false. Right. You have to qualify to be on Medicaid, plain and simple. Your assets have to be minimal. You can only have one house, one vehicle. You can't have any significant cash or investments or other real estate holdings or property. So in order to qualify for Medicaid, you basically have to scale everything back and own nothing.
Everybody's heard of a spin down to Medicaid eligible. There you have it.
And for some people, that's a plan.
Right.
For a lot of people, that's not a really good plan, but for most, that is a plan. Second part was Medicare covers long-term care cost. That is going to be false as well. Medicare, if you go to medicare.gov, the number one thing that you will find that they do not cover is the cost of long-term care in an assisted living facility or at your home. They'll cover that first 100 days of a hospital after an incident has occurred, but after that, it is on you to take care of cost of care at home, whether it's skilled nursing or cost of care at a facility, assisted living, nursing home, that kind of thing. So, oftentimes we get people that are nearing or in retirement. Long-term care is certainly
right.
a topic that we need to discuss and cover.
And there's definitely confusion around Medicaid and Medicare. The point of it, both those things, everything that Jay just said is, if you have significant assets or even a reasonable amount of assets, you want to look. If you're interested in long-term care, you need to look in the private market. Period. Right?
Amen.
Very good. All right. So Jay, I gave you the extra question, so you beat me by 1 point. So
technicality.
If you winner, you folks that place bets, which betting's illegal and or something like that. No lotto or whatever. Jay won. All right. Very good. All right. So listeners, if you'd like to chat with us, That was just some true and false, kind of give you some background and some context on things that we know in the industry. Again, I came up on the insurance side. Now the majority of my time is spent with investment management and financial planning. But, I spent so many years in that. And then plus I have Jay as an incredible resource for these things. That's just the tip of the iceberg of some of the questions we can answer around this. If you want to have that conversation, why don't you give us a call? It's 251-327-2124. Or you can reach me through my website. That's Gulf Coast FA. So Gulf like the Gulf of Mexico, Coast as in the show title, FA as in financialadvisor.com. Now on the site, you can send a direct message, or there's a blue button in the upper right-hand corner that will set up a 15-minute introductory phone call on my calendar. If you want me to call you, it has my phone number in there, but if you want me to call you, make sure you include your phone number along with your email address. All right, folks, coming up next, there's a lot going on in the world, particularly the world of finance, investments, and money. Every week, we scour the internet for financial articles related to our topic of the day, especially articles that pertain to those of you in or near retirement. So join us after the break to hear Jay and I discuss this week's relevant headlines in our News Headlines of the Week segment. Stay tuned. Whether it's building a business from scratch with your own two hands and wanting to maximize the financial impact of those sacrifices, or growing a great nest egg by being a dedicated and reliable worker for years, or choosing to live a life well within your means in order to accomplish a lifelong dream of retirement, the last thing you want is to go with the wrong financial advice after you've worked so hard to accumulate your assets. You've also probably spent most of your life putting others' needs ahead of your own, and now it's your turn. We can help. Gulf Coast Financial Advisors is a locally owned, independent, fee-based financial planning, investment management, and tax planning practice. We have offices in Fairhope and Orange Beach. We serve all of Baldwin County and the Gulf Coast. We also have an easy-to-understand fee-for-service model with no sales quotas, no proprietary products. Our ultimate responsibility is to our clients' goals and dreams. You can reach us at 251-327-2124 or find us online at gulfcoastfa.com. That's GULF like the Gulf of Mexico, Coast, FA as in financialadvisor.com. Welcome back to Coasting in Retirement. Your host Josh Knoll here. So as we discussed before the break, every week we scour the internet for financial articles related to our topic of the day, especially articles that pertain to those of you in or near retirement. Our job, or at least we think it is to help you all understand how these articles impact you, especially when it comes to your money. Now, a quick note, if you want to read our referenced articles yourself, we include the links in our show transcript, which we put up on our website on the podcast tab the Monday after the show airs on Sunday. We always have those links, and we try to do non-paywalled sites so that you're not just hitting a brick wall when you're trying to read these things. Now, with Michelle playing hooky on us this week, Jay, I'm going to be the one reading the headlines. So let's get after it with our news headlines of the week. All right, Jay, let's go to the biggest financial news we have going on right now. The Fed's recent half-point interest rate cut, or if you want to do industry jargon, 50 basis points, 0.5%. It's the first such cut since March of 2020, which I didn't realize actually. Now, listeners, you can find news articles about this. Obviously, it's dominated the headlines here recently on any news sites. I used CNN Business because their website's pretty easy to use and it has no paywall on it. The article is titled Key Takeaways from the Fed's Decision to Deliver a Jumbo-Sized Interest Rate Cut. Now, Jay, I found a couple things interesting from this article. First, there was the first time since 2005, almost 20 years, when the interest rate decision, whether it was an increase or a decrease, the vote was not unanimous. I don't know if you knew that or not.
Find anybody that has a unanimous vote these days.
Well, they've had it for the last 19 years, which is, again, surprised me. I also found it interesting that the Fed specifically pointed to the labor market as its primary reason for the aggressive cut. And the reason I find that interesting is because they've been pointing to the labor market for the reasons they haven't been cutting it here in the last several months, which tells me my gut tells me they know more about jobs than they're telling us yet. Now, not to be conspiracy Josh here, but I think they know. There's a reason they went so aggressive. And finally, just like everything else, Jay, I find it interesting that politics appear to be in the mix with these decisions. So what was your takeaway from this recent rate cut?
Josh, this rate cut does nothing for the listeners to this show on the day-to-day living and cost of our current bills.
Okay.
Period, the end. It benefits the banks. It benefits the stock market. We can see that in the results of the market performance today, this Thursday. We'll see it again probably Friday, and before the weekend, the show airs on Sunday.
Right.
So
recorded on Thursday.
Yeah, so unless you are out there in the marketplace to sell or purchase a new home where a mortgage is going to be involved, that's going to have a significant impact on your rate and your overall outflow for your monthly mortgage notes because those interest rates are that's an interest sensitive situation. Also, you've got businesses, cost of lending, that's going to come down now because interest rates are coming down. And a lot of the marketplace had already kind of built this in. They thought it was going to go down. A lot of the speculation was a 25 basis point cut, and instead of a 25, we get a 50. That's not the economists were slightly surprised, I think.
Always.
But it's a major step for that central bank as they try to go for what they call a soft landing.
Right.
Soft landing with all of this inflation. Lower rates tend to stimulate the economy while not slowing enough to send us into a recession type of situation. All it means is the companies are able to spend a little bit more because the cost of borrowing isn't as much. And those consumers that are out there in mortgage world or even commercial
car sales.
Yeah,
they're probably breathing a sigh of relief.
Car notes, there. So if we see that on those ticks down, that's going to help us a little bit.
Very
but
good.
not not the cost of going to Publix.
Right.
It's not going to help that for a long period of time.
That's a great point. And like you mentioned earlier in your answer, our target audience, now we have all ages that listen to the show, right, Jay? But generally speaking, it's people on the other side of the equation where they've paid off some or most of their debt, and the interest rate decreased actually with their fixed income and some of their interest drawing securities. It actually dings them a little bit because they're not in the borrowing phase of their life anymore. Fair?
Fair.
All right. Next up. All right. So since our main topic today has been about insurance, I wanted to find an article that discussed this recent interest rate cut and how it would impact insurance companies. So we just talked about borrowers, cars, mortgages, Publix, groceries, but what about insurance companies? And so, Jay, I found what I was looking for on an industry-facing site, probably not something the regular retail investor would read, but it's called Insurance Newsnet. Have you ever heard that?
Oh, yeah. Insurance Newsnet.
That's a big one?
INN is a long-standing.
Okay, very good.
It's a good, reputable one.
All right. Well, yeah, I tend to stick to Investment News and AdvisorHub.com and CityWire, but I was curious if you knew that one. The article is titled, Insurance Experts See Good News After Fed Cuts Rates by Half a Point. Now, the basic premise of this article is that interest rate cuts are a net positive for insurance companies, particularly when they're holding long-duration fixed interest securities. But there was a dissenting voice in this article, Jay, as a CEO that I didn't write his name down, but he was quoted as saying, lower interest rates can compress investment returns on the reserves insurers hold to pay future claims, potentially leading to higher premiums or more conservative underwriting practices. So your 25 years of experience, I know you've been mostly on the consumer-facing retail side, but you've got a lot of insight on how the sausage is made. What do you think? What's your opinion on interest rate cuts and how it's going to affect the insurance carriers?
So the way the insurance companies guarantee the benefits that they're going to pay out to all of the claims policyholders is they have to have reserves set aside. That's a federally mandated reserve accounts. They also have reinsurance with companies all over the world. A higher interest rate environment sometimes can be good for the consumer because that gives us higher dividend participation rates on the whole life contracts, higher crediting rates on our indexed universal life and maybe even our annuity contracts. However, the companies also have accounts that they have to be in conservative investments. They get higher returns on those conservative investments.
They can't be putting the money into penny stocks and nonsense like that.
So they buy a lot of government bonds, a lot of high-rated corporate bonds, and when the interest rates start to creep down, so too does their potential return. So they have to forecast that out over many, many years. The insurance companies do, and it could have an impact on the outflows the cost of the premiums. I really don't think that we would see an immediate impact from the general consumer on a 50 basis point reduction in the insurance world. There's always usually about a 12 to 18 month lag in the insurance company world. What we might see is not as competitive index performance rates in our annuities and our index universal life contracts. We might see some of the insurance companies have a small downward tick, if you will, of the dividend participation rate in a whole life contract. Is it going to affect our day-to-day? Probably not, but it's something we as insurance experts need to be aware of.
Well, and I think, real quick point, mentioning the underwriting, that seemed a little outdated to me because in my opinion, especially watching what you've done over the years, it seems like the more information and data that insurance companies have been able to collect over the last 5 to 10 years, the more efficient and more accurate underwriting has become. And in some instances, the more flexible. This is my 2 cents. There's things you and I are able to get people covered on that 10 years ago was automatic disqualifier. And now there's data to show that, well, because you might have taken some antidepressant medication doesn't mean you're 1 year away from checking out. You might live a long, long life from that, right?
That's right.
So, all right. Well, very good. All right, next article. This is from a site that we reference often on the radio show. It's called Kiplinger. And Jay, I had this whole Kip Winger. Do you know the 80s band Winger?
I didn't really listen to Winger, but I could totally see you listening to him.
I have Winger.
Hair band.
Yeah, that's right. I mean, it's terrible. What their number one song is canceled. I mean, that's all terrible. But we used to make that joke about Kiplinger, and the Winger's lead singer is Kip Winger. And we found through audience research, no one got it. It was dumb. So I just made it one last time. Rest in peace, our Kip Winger jokes. But back to it would have been like Guns N' Roses or Motley Crue, maybe,
Those everybody listening to has definitely heard of them.
Right, yeah. Winger, a little niche there. But anyway, Kiplinger had a
reputable website.
Yes, a reputable website, not 80s hair metal band. They had a recent article titled 4 Common Misconceptions About Life Insurance. And I thought this would be a good companion to our true or false discussion, particularly the section in the article that discussed how some people don't believe in life insurance. And listen, folks, I get it. Our industry is really good about shooting ourselves in the foot. It's one of the reasons we have this radio show. It's one of the reasons that Jay comes on, so y'all can actually know how this stuff works versus some of the nonsense that you see and hear out there. But, Jay, can you discuss how life insurance works? I don't want to put words in your mouth, but life insurance is shared risk, how there's leverage involved with it, particularly with the premium payer's dollar. And at least in our experience, and maybe it's because we always deal with highly rated carriers, I've always seen them step up and honor their claims. So on this article, people that don't believe in life insurance, what do you guys say about that?
You have to have an understanding of passing the risk off to someone else in order to have an understanding of the life insurance world. At the end of the day, bottom line is people buy life insurance because of something they love or someone they love. So business owners buy life insurance for their business to protect their key employees. They buy it for the love of the business. Individuals, families buy life insurance to protect those that they love and that they provide for. I'm a firm believer in the purchase of life insurance. This is September. It's Life Insurance Awareness Month. There's a lot of consumer outreach going on all over the country with respect to that. If you want to provide for your family and make sure that they're taken care of, debts are honored and paid off, providing income, providing college education for kids, those are really important features. And there are so many different insurance products out there and so many different news articles and podcasts and radio shows like this one that talk about it. Well, that's because it's important. Life insurance is an important feature of the American family network. And we have the opportunity to provide. You're never going to see somebody come in and say, "Well, I'm glad I didn't have that life insurance."
That's fair. That's very true.
Yeah. It's oftentimes term insurance is dirt cheap if you're healthy.
Right.
$1 million. We're talking about pennies a day, dollars a month for the same amount that we go to the coffee shop and buy lattes. I mean, so why wouldn't you consider it if you have a young family? If you have a large mortgage or you've just maybe refinanced, there's always a we want to have some protections in place.
Well, and I think your organization, Providence Partners and Providence Benefits, does a great job of selecting and partnering with highly rated insurance
Well, that was
carriers.
the other point I was going to make. A-rated carriers or better, and you want to deal with. And look, in this day and age, if an insurance company is not doing so hot, and we've had a couple in the last 7 to 10 years that they didn't make good decisions, and they didn't fail. They were just purchased by another insurance company.
Right.
So the claims are always have in the last many decades. The claims are honored by the insurance company that you originally purchased it from, or that was acquired by a much larger insurance company. And again, you come to us and you say, hey, well, I bought this insurance policy 15 years ago from XYZ company. I really don't see them around anymore. We can do the digging and figure out who owns that book of business, that block of business. 9 times out of 10, you're going to have a policy that's going to get the claims paid, and your family would be taken care of.
Very good. All right. Last article of the day, and actually, Jay, it's a landing page. I wanted to give listeners that were interested in learning more about you and Providence Partners /benefits a site to visit. So what I did is I pulled up the resources landing page on your website, providencepartners.org. Now, I know, or at least I think I know, that this site is geared towards producers in our industry.
That's right. It's allowed for you to give your clients some information.
Right.
But
I think this page is also useful for consumers.
Yeah.
Yeah. For example, you've got current multi-year guaranteed annuity rates, that's MIGA for short. You've got an annuity decision flow chart that I think is handy for both the consumer and the advisor or the producer. And then you got a life insurance needs calculator, and that's just naming a few of the available tools. So what do you think are highlights on that resource landing page? And understand, we do have producers listen to us on top of retail consumers. So what do you think? Tell us more about that page.
So that resources page was designed without a username and password. Everything on that page is consumer friendly. There's nothing on there that's going to, be a compliance issue, or we're not spilling any of the mystics of the insurance companies or the annuity companies. We're giving you, the advisor and agent, resources to provide your clients. And those clients that happen to navigate their way to this page, they're seeing great items there that they can learn and educate themselves. The best client, Josh, that you have is the well-informed, educated client that understands what they need to take care of, and they come into you with the plan. I love it when your clients and any of those people out there, when I have a conversation with them, they say, oh, I already know what I need. I just need to figure out how to get there and make sure that what I am understanding is true. So we've designed this resources page for all. There might be some industry information in there that you say, well, I need Josh to help me explain this. What is this stuff? What is this stuff? So at the end of the day, anybody can go there. No username, no password needed, all consumer friendly, worksheets, quote engines, calculators, quick flyers on how things work. That's what we designed it for, so it would be a benefit to the marketplace.
Yeah, that's providencepartners.org, and of course, we will have the link on the show transcript. All right, well, listeners, I hope you learned something from our discussion around these recent financial headlines. These are all, in my opinion, these are all important pieces of information that will impact those of you in or near retirement. Now, if you'd like to continue the conversation with us, why don't you give us a call? Again, that's 251-327-2124. This show airs on Sunday. Jane, I always throw it out there. When the show's over, give me a call. I'll get every now and then. I know when the call's coming from a radio show, it's a lot of fun. And every now and then somebody will call me on Sunday, and I'll answer it if I'm not tied up. If you don't want to do the phone call thing, you just want to do the typing thing, go to our website, gulfcoastfa.com. You can send us a direct message there on our contact page, or you can click on the blue button in the upper right-hand corner. That'll put a 15-minute introductory phone call on my calendar. Be sure to include your phone number if you want me to call you. All right, folks, coming up next, Josh's crystal ball and big mouth would have been some of my predictions. Have I been right? Was I ever wrong? How wrong? You've heard Michelle, just eviscerate me on some of this stuff, especially early in the year with my predictions on crypto, a little off there. So what do I think is going to affect investors in the near future, or maybe the long-term future? We just talk about all these things and poke a little fun at my big mouth and maybe even Jay's. Stay tuned.
A multidimensional financial services company, Providence Partners serves the needs of independent insurance, financial, and employee benefit professionals. The team at Providence Partners serves other business professionals like property and casualty agencies, registered investment advisors, community banks, and benefit brokers to assist in their clients' risk management planning. Whether an individual or business owner client, this planning includes income replacement protection, planning for extended healthcare costs, family needs, and generational transfers of wealth. At Providence Partners, we give you access to industry specialists. Those specialists focus on business succession, business owner planning, family and household protection, estate planning, planning for that income loss, or planning for long-term care solutions. Providence Partners is an Alabama-based company. We have offices in Birmingham and along the Gulf Coast. Our website is providencepartners.org, and you can reach us any of the working days.
Welcome back. Your host, Josh Null, here, alongside guest co-host, Mr. Jay Stubbs. So, Jay, I'm opinionated. I think you are too. We tend to have strong opinions, and I would say, a radio show host that isn't opinionated would probably be very boring to listen to. And of course, you and I are both paid in our respective professions to offer professional guidance and opinions to our various clients. You with the advisor side, me with the public side. Otherwise, what use would we be, right?
That's right.
So sometimes I feel so strongly about something, I talk about it publicly. Sometimes I'll even make predictions. And while I'm a fairly skeptical person about my industry, so I'm usually right, there are times I swing and miss. So, folks, if you want to hear me eat a little crow, let's get at it with Joshua's crystal ball and big mouth. All right, so Jay, I'm going to do this with Michelle not here to just find the one needle she can stick in my eye when I'm not looking. What we talked about, this is a repeat from last time. I think you're going to find this interesting. And listeners, I did not tee him up at all this. So do you know who Josh Brown of Ritz-Holtz Welts is?
Never heard of him.
Never heard of him. Josh Brown, downtown Josh Brown. So the Reformed Broker was his blog site. He started, 15 years ago.
Okay.
And he built that into becoming a published author. He's co-owner of Ritz-Holtz Wealth, which is a pretty sizable independent RIA. He's a New York guy. He talks like a New York guy. He's pretty opinionated, right? And he tends to kind of call it as he sees it. Well, on his site, on Ritz-Holtz Wealth sites, they had a recent study about investing during the different parties being in presidential power. So follow along with me.
Okay.
Now, you could say, what's the interest rate for the time period, Democratic or Republican, and you could figure that real easy. They did something different. What they said was, what if you were an investor starting with Eisenhower's election in 1953, and you only invested in the S&P 500 index fund during the time period when your party was in power as president. So during the other time, you were in cash. So if you're a Republican, you only invested during a Republican presidency in the market. When a Democrat came into power, you went to cash, and vice versa.
I do. This is a great exercise.
It is awesome. Now, we already aggravated some listeners because our audience tends to lean right, and I'm fine with that. But here was the fascinating thing. Part one. First was, if you invested only when a Republican was in power since 1953, and you went in cash when a Democrat was in power, if you put $1,000 in 1953 to date, you would have about $27,000. Okay,
all right.
If you did that same thing with a Democrat, you'd have over twice that. You'd have $62,000.
So back to the old adage that my grandmother used to say: if you want to live like a Republican, vote like a Democrat. Is that what my grandmother meant? God rest her soul.
Now, all right. Here's the funny thing, Jay. To be fair, and they show us in the state. To be fair, there's actually, I didn't know this, there have been more Democratic presidents than Republicans. So there was more time for the money to bake.
Okay.
So to be fair, because the actual interest rate, that's what most people, the common perception is that the Republican Party is significantly greater for the stock market than the Democratic Party. I'm telling you all, math will tell you that's not actually true. It's a little bit of a difference, but you got to remember, Democrats, generally speaking, tend to favor excess monetary supply, which is like water, flows into the market. Let's get back to my main point. If you were politically agnostic and you just put $1,000 in 1953 and you didn't care who was president and you kept it in the S&P 500 fund, 27,000, 62,000 is our benchmark. How much money do you think you'd have now if you just left it in?
Oh, wow. Hundreds of thousands of dollars.
Over $1 million.
Oh, yeah.
Isn't that amazing?
Yeah. Well, here we go. Politics and investing for the general consumer do not mix.
Right. Now, the reason I wanted to bring it up with you is one, I thought you'd find it fascinating.
That is a really, really interesting study.
Because I've been in the past, I've been like most people. I've parroted the fact that Republican tends to be better. And really what I should have been saying years ago, Jay, was, my big mouth should have been saying, ignore it. Ignore who's president. But for those of y'all that are not, because I know, you and I both know, there is real concern about who's the outcome of this election, right? So what I want to ask you in closing is, do you see, let's walk through some of the I deal mostly in stock market investments. Common listener or regular listeners know that, right? You also have a wide range of services and things you do, but your forte is going to be on the insurance side. Is that fair?
That's fair.
So for someone that is looking for alternatives and coming in the market, let's just briefly, 60 seconds or less, what's a couple alternatives that they could look at if they wanted to weather this storm and get to the other side of the election?
Yeah, so they would look at products that maybe have a downside protection built in. We have that in the annuity space, the annuity marketplace. If you want the upside potential gain, you could also have the downside risk. That's an indexed annuity product. If you're just looking for a good rate of return and don't want to have your money at risk, you could look at a traditional MYGA, multi-year guaranteed annuity product. If you want your insurance cash value policy to grow, you could look at whole life with dividend participation. There is no downside risk to that other than the cost of the insurance that's being carried. And if you wanted downside risk on maybe an index performance life contract, you could get that as well. I always like to say the baseball analogy. If you're looking at something, there are products out there that if the market strikes out, then the consumer gets a walk to first base. You're still on the playing field. However, you've got to come on the flip side of that coin. If the market hits a home run and you're in a more protected product line, you're getting a triple. Not a home run,
right,
but you're still hitting a pretty good lick. We're getting a triple on the playing field. So, yeah, I think it's important for clients to understand their risk tolerance. That's why they have conversations with you. And if they're not willing to stomach the marketplace returns, they could go into a protected product portfolio.
Well, Jay, we're running tight on time, but I've got to say this. Another thing that I think is applicable here is when it comes to income annuities that are interest rate sensitive, right? And we've been in a relatively high interest rate environment coupled with a high stock market environment. Is there potentially a window of opportunity if someone wants to take some of those gains that they've experienced over this run up on the stock market, leverage that into future or current income through a SPIA or a deferred income annuity and maybe capture just a little bit of the last gas of those higher interest rates? Is
Absolutely.
that fair?
There's probably another 90 to 120-day window where people need to explore that option.
Yeah, take the cream off the top, if you will, right?
That's right.
Very good. That's great. All right, folks, listen, one last time, we invite you to reach out to us, 251-327-2124, or go to our website, gulfcoastfa.com. Folks, that is it for us this week at Coasting Retirement. I want to give a huge thank you to my awesome co-host, Mr. Jay Stubbs. Did a great job as always.
My pleasure.
Thank you for sponsoring your company, sponsoring you and Andy's company, sponsoring the show. That's Providence Partners and Providence Benefits. Thank you to our awesome radio station. That's FM Talk 106.5 out of Mobile. Many thanks to our provider of our show music. That is local band Sloth Racer. Huge thank you to our show producer. That's my son, Mr. Peyton Knoll, freshman at Auburn University, War Eagle. That's right. Ain't that right, Jay?
Remember mine's a freshman at Ole Miss. Hotty toddy.
That's right. And as always, our sincere appreciation for all of you out there that have been listening and joining us on this journey. We would love to be part of your journey as well. Till we talk again next Sunday, have a wonderful and productive week. This has been Coasting in Retirement with Josh Knoll. Gulf Coast Financial Advisors, LLC, known as GCFA, is a registered investment advisor offering advisory services in the state of Alabama and in such other jurisdictions where it is registered, filed the required notices, or is otherwise excluded or exempted from such registration and or notice filing requirements. Registration does not indicate or imply that GCFA has attained a particular level of skill or ability, nor does it constitute an endorsement of the firm by the Securities and Exchange Commission, the SEC, or any other state securities regulator. The Coasting in Retirement radio program serves mainly to disseminate general information, including those pertaining to GCFA's advisory services, together with access to additional investment-related information, publications, materials, and links. The publication of this radio show should not be construed by any client and/or prospective client as GCFA solicitation to effect or attempt to effect transactions in securities, nor should be interpreted as GCFA providing personalized investment advice or any type of professional advice for compensation wherever this program is broadcast. Any subsequent direct communication by GCFA with a prospective client will be conducted by a representative that is either registered or qualifies for an exemption or exclusion from registration in the state where the prospective client resides. Certain information, news stories, headlines, data, charts, graphs, figures, or statistics presented on this radio program may have been obtained from third-party sources that are believed to be generally reliable, but which GCFA may not have independently verified. GCFA does not and cannot guarantee the timeliness, accuracy, or reliability of any such third-party information and undertakes no obligation to update or correct any information that may become obsolete, unreliable, or inaccurate. This radio program also contains the opinions, views, and perspectives expressed by Josh Knoll and any other GCFA representative, which are solely their own and do not necessarily reflect the opinions, views, or perspectives of GCFA as a firm. Such personal views and opinions should not be construed as endorsements or professional advice from GCFA. GCFA makes no representation or warranty regarding the accuracy, completeness, or reliability of any information on this radio program and disclaims any liability for any direct or indirect loss or damage incurred from using or relying on such information. GCFA and Providence Partners are not affiliated, nor are any of their respective representatives.